Allow me to inform you that this webinar today will be something about how to assess and tax personal properties.
Yes.
I think it should be very interesting because in Thailand we don't have this sort of thing, or maybe have some, but in the US they tax personal properties as well as real estate on annual basis. So we like to understand how do they do. Actually, I took a lot of government officers in Thailand to see property taxes in Canada, in USA, in Australia, in New Zealand, Singapore, Malaysia, and many other places. Try to do property taxes, but it is some sort of distortion somehow in Thailand. So I think this topic on how to assess and tax personal properties should be interesting for us indeed. And we have our great speakers here who are very experienced in this field. So let us wait for Madam Lisa A. Hobart. So Madam Lisa A. Hobart will be speaking on this. And allow me to briefly introduce our speakers. Madam Lisa A. Hobart. She holds CAE. CAE is the highest certificate for the International Association of Assessing Officers for CAE, and also she is a fellow of IAAO, that is the International Association of Assessing Officers, and also member of the ASA, that is American Society of Appraisers. So these are very great organization. I'm also proud to be a member of the International Association of Assessing Officers, or in brief we call IAAO. I have been members for 20 years, but now I was considered somehow retired, so I did not extend my membership. Normally, I went there for annual conference every year, rotating in different cities in the USA and Canada. Sometimes in Calgary, in Canada, sometimes in the USA and other places. So I have been there for almost 10 conference in at the International Association of Assessing Officers, and mostly I am also of speakers there on how to assess properties or mass appraisal. And I learned mass appraisal from this organization, that is the International Association of Assessing Officers. So this is this organization. So I just wait for Madam Lisa to come, and then we may discuss on this subject. Let me check. Allow me to introduce something more. Madam Lisa A. Hobart, as you know, has worked in assessment administration for more than 40 years. But you look at her face, maybe look very young, maybe really little depreciation. And also working as a personal properties auditors and administrator for Oakland County. Oakland County is in Michigan State. At the Michigan Equalization Department in Michigan State. And she retired as a chief assessor for West Bloomfield Township, Michigan, and served as the chief assessor for the city of Detroit. Detroit should be really interesting because in Detroit, once I remember I went there, they said that the house could be sold at around $1 or $2 because very few people like to stay there. They want to revitalize the city. So the houses may be taken over by the government and then they want to resell to people something. So that is in Detroit. So if Madame Lisa came, kindly tell me so that we can go further. And as you may know, that she holds a bachelor degree in accounting and a master degree in administration. And Madame Lisa A. Hobart hold the ASA designation. ASA, the African Society of Appraisers, mostly real estate appraisal as well as personal properties, plant and machineries, and also jewelries or some other things as well. So they are not only real estate appraisers, unlike the International Association of Assessing Officers, maybe mostly real estate, where I were members. And she also hold the CAE. CAE is an abbreviation of Certified Assessment Evaluator. Certified Assessment Evaluator. So that is CAE. Although I was a member for 20 years, but I earned only some classes, like the classes number 300, that is mass appraisal. There is also advanced mass appraisal and something else. We need to earn a few of those courses before we can get the CAE. So I am still far from CAE. So that is the case. And Miss Lisa A. Hobart also hold a PPS. PPS is the personal property specialist. Very interesting. Personal property specialist. So in the US, we tax real estate, and also we also tax personal properties, that is movable properties like a ship or yacht or cars, something maybe. So that is PPS from the IAO or the International Association of Assessing Officers. So is Madam Lisa Daniel here? If you come, you can kindly tell me. And she is also a certified general appraiser in the state of Michigan. And she is also a senior instructor with the IAO. So that is a professional experience. And you may know that in the USA, there is the appraisal foundation. The appraisal foundation is the one who have the valuation standards. So Madame Lisa Daniel served 2-3 years terms on the board of trustee. The board of trustee have a term for 3 years. So she served 2 terms. So altogether 6 years on the board of trustee of the appraisal foundation. I also went to the appraisal foundation. They invited me to have some meeting in Washington DC once, and also in Toronto another time. So twice there, I went there. But then Madame Lisa has been the board of trustee for 2 terms, 6 years. And she has written numerous textbooks or articles and presentation papers, particularly those for the International Annual Conference of IAO and some other organization. She should be a speaker there. And in 2023, this year, Madame Lisa was the IAO recipient of the ENW Macron Global Award for having served as the reviewer of the European valuation standard for plant machinery and equipment for European group of valuers. European group of valuers, the abbreviation is the TICOVA. T is the TICOVA, and TICOVA is the association for valuers in European countries, maybe around 40 countries or more. Some members outside TICOVA, outside Europe, also members. So there may be over 40 national association in TICOVA. So Madame Lisa has served as the reviewer for this TICOVA standard for plants and machinery valuation. And she is a lifetime designation for the recognized European values for plants and machinery equipment. So this is a very Madame Lisa told me, wrote to me that we start in about an hour, right? I told her that it is now. It is now. Sometimes I'm also confused when I speak for some classes in India or in the Philippines. I also get confusions. And once I went to conduct valuation in Indonesia for a dam valuation. I remember that we have an appointment at say 6 o'clock or something because to avoid traffic, but I remember the wrong time. So that is my fault. But in this case, sorry, I did not confirm. That is my fault also. Did not confirm with Madame Lisa Hobart. So when I have an appointment with her for this time, the thing is maybe the time not yet changed, but now it is winter. So maybe time period is already changed. So in a while, Madame should come. And
I am here.
You Madame here already. So let me just introduce you the last paragraph that is in 2018. Madame Lisa was an IAO recipient for the Fellowship Award, and fellows are individuals who have dedicated their career to the development of our profession. So she has been a great resource person of IAO, and she was also IAO 2016 most valuable members and the 2014 instructor of the year. So this is briefly about Madame Lisa A. Hobart, CAEPPS, FIAO, and ASA. So this is so let us give a big hand to Madame Lisa Hobart. So
well, thank you very much.
Yes, Mrs. Hobart, maybe you can kindly start. This session is for an hour, but if there is some Q&A, maybe a little more, but you can start talking. The file, you can share some file as well. And for those who cannot get into this webinar, we also have Zoom. We also have live Facebook Live at the FIABCI.org as well. FIABCI Thai in the Facebook as well. So please, Madam Lisa Daniel, or Lisa Hobart. Sorry, Madam Lisa Hobart.
Thank you. Thank you very much. Can everybody hear me all right?
Yes, I can hear properly.
Wonderful. And can you see the PowerPoint presentation?
Not yet, Madam. I saw you with the logo at the back. Yeah, I saw. Yeah, FIABCI
Is
World
there?
Council.
Okay.
Yes.
Wonderful, wonderful. First of all, thank you very much for having me speak to your esteemed group. I am sorry about the confusion. My calendar said 8 a.m., but I do want you to know it's only 7:15, so thank goodness I was ready. So maybe we got our times crossed, but I do apologize, but I am here now. I'm glad I saw your text. I was kind of waiting another hour to start.
It's my fault.
In
So
any
at that time, when I have an appointment with you, it is summertime. Now it is not
Oh,
summertime.
right, because
Yeah.
of the time change,
Yes.
right, right.
Yeah. Thank
Anyway, the topic today is how to assess and tax personal properties. So the fundamental premise of assessments is fairness and equity. And government, of course, relies on taxes as a primary source of revenue in many instances to fund essential services and government projects and programs that benefit the residents of those communities. How taxes are distributed is in the assessment process. So everything that we'll talk about will be rooted in this sense, this overwhelming sense of fairness and equality, equity. Most personal property assessments in the United States are based on the cost approach to value. The cost approach to value is one of three approaches to value where it relies on the individual company or business owner to report the historical cost of their assets. And then the assessor applies those historical costs within a valuation modeling system to develop an estimate of market value. The modeling system is a well-built modeling system, I should say, is based in large part on sales of information and maybe income data. So it's a modeling system that will work on a self-reported system. Most personal property systems in the United States require by law property owners to report their cost on a form or a rendition that's submitted to the assessor. So like any other laws, there are people that comply and people that don't comply, and we'll talk about that a little bit as we proceed. But as an introduction to our topic today, we start out with fairness and equity, reliance on a cost approach, and then these self-reported renditions. So starting, let's talk about what is personal property. So personal property is generally defined, broad spectrum, as anything that's not real property. Okay, so that's not necessarily real helpful on its face, but all items that are not real property, that are not specifically exempted by law. So all items that are not included as personal property, but are used in a business environment, become accessible personal property in jurisdictions or counties or states that do assess personal property. So a layperson normally thinks of personal property as the items that are movable. And you know, in large part, that isn't necessarily inaccurate, but it's not technically completely accurate, because there's plenty of items that are personal property that are not movable. So for example, you may be familiar with the concept of highest and best use. Highest and best use would, as it relates to personal property, require that the personal property be placed into service and operate for the purpose in which it was intended. Therefore, If you had major machinery and equipment that required a specific depth of concrete foundation, the concrete foundation would become part of the cost of the machine because of the concept of highest and best use. Certainly, additional concrete used to support or serve as a foundation for machinery does not add value to a building, but rather it allows the personal property to function. So we want to move past this layperson's definition that personal property is the movable things. Certainly, it's inclusive of the majority of movable things. Machinery and equipment, furnitures and fixtures, computers, some states assess vehicles. But it's more than just the movable items. In fact, there are movable items that are real property. So, for example, the storms and screens in windows, a set of keys that give you access to real property. Those are real property, even though they are movable. Personal property can also include leased equipment. Leased property is accessible to its owner in the United States in most instances, otherwise the party in possession. Now, there's leased equipment is a contractual agreement between a provider or the lessor of property and the lessee, the user of the property. Now, this creates some unusual circumstances because there are many tax-exempt entities, such as religious institutions, that are exempt from traditional property taxation, yet they lease or rent equipment from a provider. Well, the exemption for the leased equipment does not pass to the provider. So, for example, if you had a leased equipment to a religious institution, we would assess the leased equipment to its owner, the leasing company. The leasing company may say, our agreement with the lessee requires that the lessee or the user of the equipment pay the property taxes on the equipment. And because they're exempt, therefore we're exempt. The statute does not permit pass through unless it's specifically written that way. Most states, the property would be assessed to the leasing company, and we don't, as assessing officers, get in the middle of that development of or interpretation of their contractual agreement between a lessor and a lessee. So the technical definition of personal property as prescribed by IAAO, the International Association of Assessing Officers, has three primary components. And the first is that personal property is an item that is annexed to the realty or pertinent thereto. And I want to correct what I said. It's defined based upon these three tests. So if the item is attached to be used in the real property, so for example, the example in item 1 is a boiler. You have a boiler, but it provides services to the real estate, say hot water or hot water heat. The boiler then could be personal property in one instance, but in this instance would become real property. Let's say that the item has a specific purpose to the real estate, such as the storm windows we made. That we talked about earlier. And lastly, the intention to make personal property a permanent addition to the real estate is stated or implied. So often we look to the agreement. Let's say we have a shopping center, and the shopping center leases a space to a store, and the tenant makes improvements to the store. The tenant lease agreements overwhelmingly make the tenant responsible for all the improvements they would make in that lease space. In fact, the majority of lease agreements would not only make the tenant responsible for the taxes on those improvements, but require that they restore the property to the condition it was in at the inception of the lease. So that can create some very unusual circumstances. So in one example, when we were talking about highest and best use and the improvements to real property, let's talk a moment about before we get to a car wash. Let's talk a moment about a hair salon, something as standard as a place where you get your hair done. So let's say there's a store and a storefront shopping center. They open a hair salon. They put in all sorts of shampoo bowls, electrical outlets to run hair dryers and all those things. You and I might often think that, well, electrical work and plumbing work, that's got to be real property. And it's not, because the intent of the parties, going back to our definition here, the intent of the parties was that they would be responsible for those items. And furthermore, if you have a shopping center, you don't add value because one of the storefronts happens to have additional shampoo bowls and electrical outlets. That doesn't add value to the highest and best use of a shopping center. It adds value to the highest and best use of a hair salon. So in those instances, certainly plumbing and electrical would be defined as personal property. There are things that we look at as personal property appraisers that we need to look at the real property appraisal record card. And much study has been given to the development of real property assessments. So if I truly wanted to know in a business environment what is not included as real property so that I could assess it as personal property, I would go to the real property record card, the appraisal of the real property, and say, you've included this item or you have not included this item. Such is the case with a car wash. So if you use a standardized modeling system in the United States, oftentimes the conveyor equipment in a car wash is not included as real property. So there's significant costs that could be added to a personal property item. So we talked about a shopping center. We've talked about a car wash. If we're really looking at the test, the personal property appraiser, if all of us were going to determine whether an item was real or personal property, I would suggest that we start with looking at the real property appraisal record card, determining what is included in real property so that we're not assessing it twice, but that we are assessing property that is subject to taxation that is not included as real property. There are other items that require careful evaluation, and some of them are listed on your PowerPoint right now. Canopies, so the canopies that they would have, say, at a gas station, where they cover the tanks and the pumps. You know, there were instances over the years where we were studying what's included as real and what's included as personal property. One area that has been discovered to be highly inconsistent is the underground tanks at a gas station, or the above ground pumps that you actually use to fill your car. There is inconsistency in some jurisdictions about what is real property and what is personal property, in addition to the canopies that may cover a gas station pumps and tanks. We talked about conveyor type equipment for car washes, but there could also be equipment add-ons, robotics these days, yard paving, yard lighting, signs are often a definition of personal property, signposts or poles. We talked about the hair salon. The same would be true, quite frankly, with a laundromat. You know, if you have a laundromat that is part of a shopping center environment, it is likely that you as the appraiser is saying that the shopping center, the highest and best use of the shopping center is a shopping center. It's not a laundromat. And so if a laundromat goes in, they also would have likely have additional plumbing and electrical fixtures, etc., which would in that instance be defined as personal property. Now it is different. It's kind of interesting that if you had a freestanding building and as an appraiser, you went to that building and said, this building, the highest and best use is as a laundromat. You would go to your modeling system, you would value it as a laundromat. And if you did that, then those plumbing and electrical items would likely be real property. So a specific item, depending on its installation and use, can change its nature as to whether it's real or personal property. I've often thought if you went to a home goods store that sold switch plates or electrical switches, in that environment, that's inventory and would be personal property. But if a builder buys 100 switches and installs them in a building, they become real property. And then certainly the computer center operations may add a significant amount of coaxial cable, electrical outlets, generators. The generator may be dedicated to the computer center operations and not a generator specifically to provide utilities and to the building. So the bottom line test is to look at the law, determine what type of personal property is subject to taxation, what type may be as exempt, look at the real property and determine what is there. And if it's subject to taxation and it's not included as real property, then it's personal property. And personal property is broken into these four major categories: fixed assets, inventory, leasehold improvements, and intangibles. And let's talk about these. Fixed assets are defined as property that would have an economic life of more than 1 year. Typically machinery and equipment, furniture and fixtures. Fixed assets is likely the largest category of assessable personal property. But it is important because the definition, personal property being property that has an economic life of more than 1 year, fixed assets is not synonymous with personal property. Because a building is a fixed asset, land is a fixed asset. And so it doesn't mean that all fixed assets are personal property. It merely means it's a category of personal property. Now, the next category is inventory. In the United States, some states assess inventory, some states do not. And inventory is defined as property that's held exclusively for resale. And we include that word exclusively because if you didn't, everything potentially could be inventory. You may have heard that adage that everything's for sale for a price, you know. So that would mean if you had a large business, manufacturing operation, they could say, well, everything's inventory because I'd be willing to sell it. So we say that for it to be inventory, it must be held exclusively for resale. And the type of property that would fall within inventory would include raw materials that they may bring into a manufacturing operation, finished goods, property held for resale in a store. For example, a manufacturing operation may have raw materials on hand, and through the manufacturing operation, they convert those raw materials into a finished good. So at some point, the raw materials could be construction in progress or work in progress. and then they have a finished good. Inventory would continue then from a manufacturing operation to a wholesaler. At the wholesaler, they would still be inventory because the wholesaler is going to repackage, remarket these items to send to a retailer. A retailer then would ultimately sell it to a consumer, and the consumer may convert that item into a business item and it becomes a fixed asset. So inventory can be converted to a fixed asset when acquired by its ultimate user of the product. But through that process, up until that process, it is likely inventory. Leasehold improvements are the third category, and leasehold improvements are items that are installed on real property. And we mentioned a few of those earlier in our examples of defining personal property. But leasehold improvements could include things like shelving, cabinetry, lighting, the sinks, electrical. The decision as to how they're assessed is going to be made, as we described, by looking at a real property record card and determining what should be included as personal property. In the United States, most property that's used in a business environment is accessible, and it's accessible as either real property or personal. It can't be both, and it's important that you don't allow the property to escape taxation when it's accessible. So to safeguard against that, we would evaluate whether it's real or personal. The next category is intangible property, and intangible property represents evidence of ownership. Most states do not assess intangibles. They specifically exclude them. And intangibles can include things like a patent, a copyright, goodwill. But what is interesting about an intangible is software. And a lot of states have really struggled with whether or not software is an intangible. And so, for example, if you buy a CAM software package, you don't really own that package. You have a license to use the software. Licenses are typically identified as an intangible. But then that begs the question, what if you develop software that's custom and you are the owner of it? Then perhaps software is a fixed asset. So there has been some discussion and inconsistency in the assessment of fixed asset or of software on a state-by-state basis. Our next portion of the discussion this morning is discovery. Okay, so let's assume for a moment we have an idea of what we're trying to find. We know how we're going to determine whether it's real or personal. How are we going to find it? Now, a strong case can be made that if we're going to assess personal property, that discovery, finding it, is the single most important aspect in a personal property taxation program. And we can't assess what we don't know is there. So we might use aerial imagery, photography, business licenses. Many municipalities require that businesses obtain a permit or a license to operate. That can be a form of discovery for the assessor. Building permits. So if somebody's going to put up a commercial building, when they construct a building, it's likely they're not leaving it vacant. So if you have a permit for real property, that likely means we should be adding for personal property as well. The next is canvassing. Canvassing is the most important or most valuable method, certainly the most comprehensive. Canvassing would really mean going out to the field, going door to door, checking every business, identifying what they have. And we're going to talk a little bit more about canvassing. Other options for discovery could be trade magazines, phone books, other personal property renditions, newspapers, magazines, code enforcement reports, fire reports, internet searches, the companies that leasing companies that have leased equipment. Sometimes they attach a list of all the people they're leasing property to. But the most comprehensive is going to be this canvassing method, going to the field. So we never start with a blank sheet of paper. You always have, if you've been assessing personal property, last year's assessment roll. Now, let's say for a moment you haven't been assessing personal property and you decide you want to. Well, we need to start out in an organized way. We need to start out, if I'm in an area that has been assessing personal property, I would start with last year's assessment roll, and I would organize it in street order or in a geographic order or methodology. If I were starting from scratch, I would use a map or some type of a aerial overview so I could ensure that we were covering the geographic boundaries of our municipality. I would visit each site. I'd go in, hello, this is Lisa Hobart. I'm here from the assessor's office, and we're updating next year's personal property assessment roll. Inquire about the property in their possession that they own versus something that someone else owns. Determine whether there's any subtenant. Ask if you can walk through the property, a tour and make an inspection. Estimate the square footage of the property. Why do we need that? Well, we can develop a methodology that we'll show here shortly, where we could look at what some personal property taxpayers would file. And we might be able to come up with a methodology that says, you know what? We can come up with an average value per square foot for office space or for medical office space or retail or restaurants. So if we know the square footage, we might be able to develop a comparable. Verify the business name and address, record the name, contact information, date, maybe get a phone number. In a database, add this information within a database so that we can begin to communicate with them and perhaps send them personal property assessment information. So this example that you're looking at on your screen now talks about what happens when we're trying to come up or develop a gross rent multiplier or gross income multiplier for personal property. You may be familiar with the development of a gross income multiplier for real property. A gross income multiplier is a relationship between what a property would sell for and what it would rent for. And in this example, we have the development of a gross rent multiplier. Now, the difference between a gross income multiplier and a gross rent multiplier is a gross income multiplier is annual rent. A gross rent multiplier is monthly rent. So in personal property, we typically use a gross rent multiplier. So in this instance, if I was looking at office leased equipment, you may have in comparable property A, $16,000 is the selling price of a machine. It's renting for $800 a month. You'd simply take the $16,000, divide it by 800, and come up with a gross rent multiplier of 20. Well, you can see that following that same mathematical process for comparable property B and C also results in a 20. Well, it makes it very easy then if we discover during our canvas that there's leased equipment and they don't file or we don't get data from them. This 20 becomes a very powerful tool in the valuation of personal property because I can simply take the estimated monthly payment of a piece of leased equipment, multiply it by 20, and estimate the property's market value. For example, on this slide, it says we had monthly rent of a subject property at $500. And you can see we had 8, 4, and 6. Well, if I took the 500 times the 20, I would get an estimated value of 10,000. And that fits perfectly between these, between the 4 and the 6. It fits, it's a valuation tool that is a very powerful tool and yields very credible results. Continuing with our discussion, going back for a moment, when we visit each site to determine the company's name and who's in charge, we're going to ask them about this leased or rented equipment. We're going to ask them about other people that are operating at that location. We want to know the nature of their business, the type of equipment they have. Now, there are a couple of different types of leases, and I want to make sure we're kind of clear on that. The overwhelming majority of leases that are written are operating leases, and they're like a rental agreement. So if I were renting equipment from Sopon, and it was an operating lease, I'm going to use it for a period of time, and then I'm going to return the equipment. Alternatively, we could enter into a capital lease, and a capital lease would indicate that I intend to become the owner of the property. Maybe after I make a certain number of payments, maybe after I've made all the payments, the property would pass through ownership to me. So on page 10 of our written presentation that I hope that you all have, it says that an operating lease does not affect a balance sheet, that the user of the equipment would not consider the property to be a fixed asset. Ownership does not pass from the lessor to the lessee, and the lessee may not take depreciation on the personal property. And the term of the lease is negotiable. It could be a year, 2 years, kind of whatever the parties agree to. Now, a capital lease, ownership does pass. Ownership passes at the time you enter into the capital lease. It's in the United States, it would be like buying a house, and the leasing company would act as a lien holder on the property. Depreciation can be taken by the user of the equipment, and at the end of the lease period, there's normally a very nominal price to buy out the lease. When we're conducting this canvas, inquire about other businesses at the location. Record the name of the person that you spoke with, the business name. Record the nature of the business enterprise. We said discover or estimate the square footage of the property. And if the municipality is, or if the company is new to the municipality, ask if they were located somewhere else. A couple of additional tools is if a company is no longer in business, try to find out, did they go out of business or did they move? From a tax perspective, they may have been taxed in your municipality, but if they didn't pay the bill, they may still owe us money. So we're interested in where they went in an effort to try to collect our money. Ask for a tour of the property. And if the company is no longer in business, certainly remove them from your assessment roll. The next part of the process, so once we complete this canvas, we're going to mail all of these blank renditions to property owners. Big cost, there's quite a bit of cost associated with that. And the requirement would be that they would report the cost of their assets, all properties subject to taxation, that they would report it to the assessor so that the assessor then could apply a cost approach for the valuation of the assets. So we provide these renditions, we as the assessor. Then the renditions start to come back into our office. And there are three primary reviews that we would do in looking at these assets. We would compare the current rendition to the prior year. We'd compare the current year rendition to any property canvas notes that we made out there when we were conducting this comprehensive canvas. And certainly, if we have had previous experience with the company, maybe through audit or other functions, we would compare our rendition to that. So we're looking to make the most detailed review, short of completing an audit, as possible when the reviews are being done. So on page 12 of our presentation, when the renditions are coming into our office, we want to date stamp them. We want to retain them. We want to show the mathematical calculations of how we developed a cost approach. It may actually, when you were out there canvassing, it may be helpful to go ahead and mail a rendition to those that you know went out of business, just for the purpose of seeing if you could get a forwarding address for them. If the rendition is returned, we can verify that they were out of business. If it's returned as undeliverable from the post office. The appraiser and auditor should carefully consider the data that is contained on a rendition, because the adage is garbage in, garbage out. If the rendition isn't good, then the application of a modeling system to convert that into an estimate of value is going to be flawed. There's no doubt about it. Additionally, it may be necessary to conduct a physical inspection of the property to validate any property that the model doesn't work. Meaning that property has been permanently idle, meaning it's no longer in use. It's obsolete. It still physically exists, but it's obsolete or surplus. Or we may need to do a physical inspection if the owner requests additional forms of obsolescence. So how can you have obsolescence in machinery? You can have obsolescence due to functional inutility if the machine, for example, is a manual machine as opposed to computerized. You can have external obsolescence. External obsolescence would be a loss in value, a permanent loss in value from causes outside of the property itself. And a real easy example in my mind of this would be if you had a company that made tiles. Let's say they made tiles for building materials. And let's say that those tiles contained a chemical called asbestos. Well, when the United States said, we're not going to allow asbestos to be used in building materials, as many countries around the world have excluded, it made the equipment associated with making asbestos tiles obsolete due to health concerns. So it may be necessary to dig in a little bit deeper if you have issues related to obsolescence of property. So once we're satisfied that the data that we've received is credible, that we've evaluated the renditions successfully, we're going to enter this into a computer-assisted mass appraisal model. This is the model. Most models are computerized. So we would enter the cost data. The modeling system would convert that historical cost as reported by a property owner into an estimate of replacement costs new and provide for depreciation. So the information reported on the personal property renditions, including any adjustments that we may have made as a result of our inspections or obsolescence, must be entered into the computer system so that an estimate of value can be made. Now, we require that the property owner report historical cost. Historical cost is the price paid at the time it was initially acquired by the original owner. So we want the cost to the first party. If you buy something used, that is not its historical cost. Historical cost is the most reliable basis for use by the personal property appraiser. Now we want installed historical cost. All cost associated with placing the property into service. So earlier, when we first started defining what personal property is, we said, well, it might include the concrete foundation. In the United States, it would include that, freight, sales tax, installation, all cost associated with placing that fixed asset into service would become part of its assessable basis, depending on, of course, if there's not any specific changes from state to state by law. The basis for the mass appraisal of personal property is installed historical cost. The installed cost is entered into the database, the computer assisted mass appraisal program, by year of acquisition, by personal property type. For example, machinery is often valued using a model differently than furniture. And even within the machinery category, you could have computers, you could have short-lived items such as shorter-lived like medical equipment, which would have typically have a shorter life than heavy machinery and equipment, milling machines and lathes. So within the machinery and equipment category, you could have subcategories. So here's an example of what we would want reported as cost for an asset. So we would have a machine that had a cost of $50,000, sales tax, perhaps $2,500, electrical service for the machine, $1,200, a foundation required for the machine, $3,500, someone to install the machine, $1,800. So if we were requiring the property owner to report all costs associated with placing the asset into service, we would say that they should be reporting $59,000 for the year that it was acquired. Adjustments may be required to the historical cost of a machine if the machine has been rebuilt or overhauled, meaning if an overhauled machine, you've taken components out, you've put components in with the idea that it's going to extend the machine's overall total economic life. There are three primary methods of estimating value for people that don't comply, someone that doesn't file at all. And one would be a physical appraisal method, which is a very detailed method. One is a square foot rate method that we talked about earlier, valuing property on a square foot basis, or some other unit of measure. Maybe in a hotel or an apartment building, you might say a value per room or unit. The physical appraisal method is very detailed. We identify each asset and apply the three approaches to value. The square foot method is used often. So here's an example of store A and B. And store A and B has 20,000 square feet. We applied an inventory rate based on quality and density. Quality is the quality of the good itself. Density is how much of it do they have within a defined space. We do the same for fixed assets. And this is in your packet. So if you're studying, the fixed assets depreciate, inventory does not. We apply a rate per square foot, and we end up with a total value to estimate the property's value when they are non-compliant. So this is labeled non-filers of personal property. It could also be people that filed that didn't file accurately. And the unit of measure method here, they say maybe a gas station is per pump. At a bowling alley, maybe we apply value per lanes. After the values have been set, there is an opportunity to have discussion. Valuation disputes will occur for sure. And there will be disputes regarding the cost of the asset, the value of the asset, how depreciation was applied, and quite frankly, whether it's assessable or exempt. Those types of challenges and disputes are, in my mind, best resolved by listening, education, communication, education. It's necessary to carefully plan each one of these activities and allocate the time necessary to perform the task. I do a lot of instruction for IAAO in the area of personal property. So this has been just really a snippet of kind of a very high level overview of how a personal property assessment administration program would operate. Certainly auditing becomes a part of this. If you audit personal property renditions, it certainly provides for equity. It encourages compliance. It expands discovery. You find other properties or businesses. It ensures, or at least enhances, compliance with laws. It provides for assessment of all property. It helps ensure that we're assessing everything pursuant to law. And we said provides for equity among similar situated properties, so that we're treating all restaurants the same, all gas stations the same, all business offices the same. In conclusion, the best practices of a personal property program is that you need to develop a program that is comprehensive, multidisciplined, multifaceted methods of discovery, a systematic method of evaluating the accuracy and validity of the renditions themselves, an understanding of the accounting influences that may affect property and how it would appear on a company's accounting records, a fair and equitable method to estimate value when someone doesn't comply with filing, the ability to properly evaluate valuation disputes, a carefully planned system for the administration of personal property, and a skill set to conduct audits for the purpose of ensuring and validating the costs that were reported and the value that's been determined. I want to thank you very much for the opportunity to share with you today. I, again, apologize for being late. For you, I was late. For me, I thought I was early.
Thank you very much. You are so kind and so generous and so knowledgeable to share with us. So for our participants, any comments so far? Madam, your presentation, could you kindly send to us so that we can probably share to our colleagues here?
Yeah, of course.
Thank you very much. So any comments or something?
Any questions that I can answer for anyone? I hear none.
Madam, when you are the assessor, chief assessor for a county in Michigan, how much is the property tax you can levy every year? Normally, how much is the property tax?
The tax rate is the same as it is for real property.
Say maybe 2-3%.
Now, it's interesting. I am aware about, in most cases, it's going to be between 2 and 3%. Now, it's kind of interesting that I'm aware of some municipalities across the country that have such major manufacturing operations that the personal property total dollars collected is greater than the real property.
Oh, really? Oh, personal
Yes.
property more. Say maybe 60-40.
I've seen, yes, in some, not everywhere, of course, but when you have these major manufacturing facilities, that can happen.
Oh, I see. I see. Oh, then say the property tax is how much percent of the property tax as a whole is how much percent of the income of the municipality in your case,
Well,
madam?
it would absolutely determine on where you are. So when I was the assessor in West Bloomfield, it was pretty minimal, but in Detroit, significantly higher, so that will absolutely vary depending on the kinds of businesses that a municipality has.
Say in Detroit, big city, maybe property tax maybe around 40% of the total revenue of the
It very well could have. It very well could have. I'm not sure, but it could have.
Oh, I see. I see. Amazing that your property, your personal property tax is higher. And
เพราะว่าหนู
another
เขียน
thing
หนัง
is,
สือเล่นจนแบตหมด
yes, any question, miss? Any question? Not yet. So let me just ask that in real properties, normally they will have reassessment every year, maybe 1/3 of the city and 1/3 of the city and 1/3 of the city. So every year. So
Yeah.
what about in personal property, madam?
Every year.
Oh,
Every
same.
year. It's exactly the same as real.
But you may have you may need a lot of resources, a lot of people to do that.
You do. Now, some of it can be a crossover. So if you have a commercial real property appraiser, while they're there, they could be trained, also pick up the business personal property. So with the right organizational influence, you can really kind of cross-reference or consolidate some of these tasks.
I see. And in the case of the database in Thailand, in India, in many countries in our region, the database of personal properties like plants and machineries may be very limited. Any suggestion for us, madam?
Well, I've been around doing this so long, we didn't even have a computer system when I started. So yeah, I've been doing this 44 years. So I think that you start out with a database that could at least accommodate name and address, value, valuation. And then several of you have been exposed to what some software systems can do at the IAAO conference. And so you're able to, over time, develop a modeling system that might work, but you have to start small. We all started somewhere, and when I started, we were still doing it with pencil and paper too. So I know it can be done, but you can't go from not doing it to having it perfect in a year. It's got to evolve,
Wow, very great. I also in the period of punching card, madam, long time ago in 1983. In 1983, long time
Oh,
ago.
yeah. Well, you're a rookie from me because I started in 1979.
Wow. But you still look very young, frankly speaking.
Thank you. Bless you.
No, very little depreciation compared to me. Oh my God. Another thing, madam, for Detroit, I went to Detroit when we have IAO conference, annual conference in Grand Rapids.
Yes.
One day I went there, and then I went to Detroit. My friend took me there, and at that
Yes.
time, a lot of houses were sold at very low price, so that people can come in to solve the problem of revitalize the city or something.
Yeah.
So, what is your experience about how to revitalize the city or property? How the property tax can
Well,
help that?
there's a lot of
พี่เน
debate
วัด
on
พู
that.
ออกมาทำไม ลูกขุนหลวงอะออกมาแป๊บเดียวเอง มาทำไม
Maybe some people did not close the microphone. ช่วยปิด
Right.
ไมโครโฟนหน่อยนะครับ
You
Yes,
know,
please go ahead,
they-
madam.
They've tried a lot of things in the city of Detroit to, now they're considering, I think, a land tax. Detroit's made great strides. They suffered greatly for a lot of social reasons, I think educational reasons. But the city of Detroit has many great things to offer, and
Yeah.
so I continue to remain hopeful that not only will they survive and improve, but they will thrive. So, they have a lot to offer. We have some great sports teams. If you're into sports at all, we have football, baseball, basketball, hockey. We've got it all in Detroit. Yeah.
I see. Yeah, great city.
Plus we have Motown.
Yeah, great. But right now the city may be better than the past. In the past,
Yeah.
it was really bad, but right now I think it should be recovered to some extent.
It's recovering nicely. I think most people would agree. It's still a ways to go, always a ways to go, but I think doing better than they did.
Yeah, inside the city, in the hub of the city, a lot of great things to see, a lot of
Yeah.
great buildings to see.
Absolutely. Very architecturally interesting. Absolutely. A lot of historical buildings. Correct.
I see. Yeah, thank you.
Yeah. But thank you very much for the invitation today. And once again, I apologize for the difference in the time.
That's my fault, madam.
We were able to connect, and thank you for sending me the email. And if I can be of help to you, please feel free to reach out.
Okay, so thank you very much, and have a great morning. God
Thank
bless
you.
you.
Same to all
care,
of you.
madam.
Well, for you guys, it's evening, right? Have a great evening. That's right.
Thank you very much.
You're
Take
very
care.
welcome.
Yeah.
Thank you.
Bye bye,
Bye-bye,
madam.
everyone.
Merry Christmas. Merry Christmas.
Thank you. Thank you. Take care. Bye-bye.
Take care. Bye bye.